Hi, I'm Alex. Welcome to the channel and thanks for tuning in. So in today's video, we're going to be talking about BFT and Paysafe again and looking at fundamentally why this stock is still undervalued. We're going to be looking at three different pieces of analysis which all indicate a similar stock price target range. And so if you're an investor in BFT, you definitely don't want to miss this one. Some bits of this analysis I have shared in previous videos before. However, there have been changes in the market and so this analysis is now updated. We'll also look at one other piece of analysis in more detail, which has not been shared on this channel before, and also explore the reasons as to why BFT may be undervalued. If you don't want to stick around for the whole video and you just want the high level points, here they are. If BFT was to be valued in line in peers, i.e. on the same EV/EBITDA multiple as the other payment processing peers, then this would imply a valuation of between $50 to $70. Based on how the market is currently valuing growth in this sector and based on BFT's growth prospects, the stock should be trading at around $65. Now that analysis does factor in growth that's delivered from M&A throughout the forecast period. However, given Paysafe has done it historically and Foley has a very strong track record for this, I think we can account for some of that. And finally, on the basis of IPOs that have recently happened in the sector or are upcoming, assuming the same EV/EBITDA valuation, this would imply a valuation for BFT of around $65 to $70. Clearly, on the basis of these three different pieces of analysis, the one thing that's in common between them is the fact that BFT is undervalued. Now we will cover more detail on this analysis later in the video. However, the key question we need to answer now is why is BFT undervalued? Well, part of the main reason for this is the fact that BFT is a SPAC. Now there are a number of investors who can't invest in SPACs for whatever reason that may be. And if we look at some of the investors in the other listed companies in the payment processing space, these are investors that likely would want to invest into BFT if they could. Reasons perhaps they can't invest into SPACs is due to the inherent risk of perhaps the transaction not completing, or alternatively the lower levels of financial disclosure that you have within SPACs versus other listed companies. Now again, we'll get into much more detail on this shareholder dynamic later in the video. Now my friend John, who's also a moderator on the SPACs subreddit, did post this analysis on there the other day. And so hopefully in this video I can address some of the questions that people raised on that thread as well. If you're new to the channel and you like investing related content, then hit that subscribe button. The YouTube algorithm doesn't like my unpredictable upload schedule, and as a result, oftentimes my videos don't get pushed onto people's homepages. If you want to make sure you don't miss an upload, hit that bell button next to the subscribe button, and hopefully that will mean the videos do show up on your homepage. If you like the video, please smash the like button, it's so helpful in pushing the channel to a wider audience. And as always, I'm not a financial advisor, this video is purely for educational and entertainment purposes only. And given the nature of what I'm sharing here in terms of my own analysis, which is a function of the assumptions I've made in that analysis, you should always do your own due diligence, always run your own numbers and your own models. However, let's get straight into it. Now firstly, let's look at the analysis which shows how BFT is currently discounted in valuation to the peers. Now you can cut this analysis in any number of ways, but the key takeaway under any of these scenarios is that BFT is undervalued. If you take the average forward-looking multiple for the payment processing sector currently, and apply that to the forward EBITDA of BFT, that implies a valuation of around $50. However, looking at this, the bear case argument would be, hold on, Square and Adyen, they're both outliers, they're trading at a much higher level than the rest of the peer set, and as such you should remove those from the average. Now, whilst I disagree with that argument, and I'll come on to why in a second, even under that scenario, it still implies a share price of around $23. Now at the point in time I filmed this, and hopefully it doesn't take me too long to get it edited and uploaded, that still represents a premium to where BFT is currently trading at. However, there is a counter argument to that bear case. Paysafe actually serves high growth, very in vogue end markets, primarily the iGaming, online gaming and the cryptocurrency markets. These sectors have very strong tailwinds and in themselves underpin the forecast growth for Paysafe. Looking at the end markets Paysafe serves, one could easily argue it should be valued at the premium end of the sector, given this. So taking the average multiple of those premium peers, that ultimately then implies a valuation of around $70. In short, when looking at valuation versus peers, there's a really strong argument for a valuation range of between $50 to $70. I really don't think the argument of that lower $23 price is fair. Now the second way you can look at it is by looking at how the market currently values growth and what the growth that we believe Paysafe can deliver should imply for its valuation. Now the reason this is important is because the offering between different payment processing providers is fairly limited. Yes, they may have slight nuances which make them more suited to one sector than another, but ultimately the proposition is fairly similar. And that's reflected in how the companies generate fairly similar margins when they're at scale. As such, the key differentiator for valuation here is driven by the growth and the growth prospects. This means that by comparing the forecast growth which each of the companies is expected to deliver, and comparing this to the valuation multiple, we can run a quick regression analysis to understand how the market values growth. Now, looking at this chart here, you can see there's a strong degree of correlation, meaning that the faster growing a company is, the higher it's valued in the market. Now, the next step is to take this algebraic equation, which we have from the analysis, and based on what we believe the forecast growth of Paysafe to be, calculate what the implied valuation multiple should be. If you look at this on the basis of just the organic growth alone, this implies a stock price of around $20. However, personally, I believe that acquisition-led growth will actually provide incremental growth to that organic growth and be a fairly big component to the business plan going forward. You just need to look at the acquisitions the business has done historically and also look at Foley's track record on delivering acquisition-led growth and growth through M&A. So taking the growth which a business has delivered historically, including M&A as a proxy for what the business could deliver going forward, and running this through our algebraic equation, gives you a share price of around $65. Now, some people have asked me with regards to this analysis why we're not adjusting the net debt or why we're not adjusting the share count figure. Well, firstly, we're looking at the valuation at this point in time, the valuation today. What's more, adding things like that, adding adjustments to net debt, adding adjustments to the share count, adding adjustments for the cash which the acquired business generates, and factoring that all into net debt, just adds another layer of assumptions on top of everything. And ultimately, without having much of a basis for that to be underpinned by, just becomes an assumption for the sake of an assumption. Directionally, this is correct, and from what we know at this point in time, it makes sense. Now, the third piece of analysis which we can do, which demonstrates why BFT is undervalued still, is by looking at the IPOs which recently have happened in the payment processing sector and which are upcoming and where we know what the valuation for them is. Now, a firm has recently IPO'd, and Trustly and TransferWise are also expected to IPO within this first quarter. By looking at what professional investors who are participating in these IPOs are prepared to pay for the business, it should give us an understanding of what BFT should be valued at if those same investors could be investing into SPACs. As we can see from the Affirm shareholder base, a number of these investors are interested in investing in the payment processing space. They have a number of investments in a number of the peers, and it's very reasonable to believe that they may want to invest in Paysafe, but can't whilst it's a SPAC. However, having an understanding of the valuations they're prepared to pay for similar assets in the sector is a very useful benchmark. Personally, I do believe that a number of these investors, once the transaction does complete, will seek to make a position in the stock. The interesting dynamic then at play is how this works against the selling shareholders CVC and Blackstone and whether there's a dynamic there. Now, I will cover this in a dedicated separate video on how they may exit. However, there is the potential for a secondary offering, which would mean they could exit their position to these new shareholders coming in. How that all plays out, the dynamic there, is very interesting and one we should definitely consider. So in completing this analysis, I have had to make a couple of assumptions, and I want to walk you through those so you understand what they are. Given we're looking at forward EBITDA multiples, we need to understand what the potential forecast EBITDA is for both of these businesses. Currently, we don't know that for either Trustly or Affirm, so I've had to make some assumptions to get there. Now, for both businesses, we've assumed that the historical revenue growth that they've achieved is delivered this coming year, and so the forecast revenue for next year is in line with the historic growth. And then to ascertain the EBITDA margin, we've taken the average EBITDA margin of the peers. Now, given we discussed before, the product is quite commoditized, and once at scale, all the peers operate at fairly similar EBITDA margins. I think this is a fair assumption. However, I do appreciate there are some holes in this. So then taking the valuation which we know, and dividing that by the EBITDA which we've calculated, that then gives us an implied EV/EBITDA multiple. As you can see from the analysis below, the implied EV/EBITDA multiple from these two IPOs itself implies a share price of between $65 and $67. So look, there you have it. 3 different pieces of analysis. All seem to indicate that BFT is fundamentally undervalued. And yes, I know the stock prices which come out from those analyses is a function of the assumptions which have been put into them. However, directionally and indicatively, that is correct. However, somebody taking a different view on those assumptions, using them in the same model, would ultimately come out to different stock prices. So as always, do your own due diligence. Understand where you think the valuation should be. And don't just take someone's word on the internet for that. But look, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel and you like investing related content, then hit that subscribe button. And as always, please let me know your thoughts and comments in the comment section below. There's always some fascinating debates, discussions, opinions raised, so please keep that up. I find it so interesting. Thank you so much for watching, and I'll see you in another video.